Welcome back to Insights That Matters, where we like to take these really complex business stories and break them down into something you can actually use.
Yeah.
And today we're going to be diving deep into a company that's been making headlines.
Right.
Raymond. And helping me untangle this corporate puzzle is our expert in all things business and finance.
Happy to be here.
Thanks for joining.
Glad to be here.
So, okay, imagine, for our listeners who might not be familiar, imagine a company that makes those sharp suits you see in their ads, but also makes parts for your car.
Right.
And Inno develops these huge real estate projects.
Oh, wow.
That's Raymond in a nutshell.
Yeah.
A real mix.
That is quite a mix, isn't it?
Of businesses.
Yeah.
And get this, they've decided to split it all up.
We call these companies conglomerates.
Right.
They've got their fingers in all sorts of pies.
Yeah.
Raymond's got textiles, obviously.
Right.
But also this big engineering arm.
Right.
That includes JK Files.
Yeah.
The world's largest steel file maker. And even
the growing real estate business.
the growing real estate business.
That's right. And that's what makes this demerger.
Yeah.
This splitting up.
Yeah.
So interesting.
It's true.
It's not every day you see a company decide to completely dismantle their structure like this.
Right.
So why are they doing it?
Well, think of it like this.
Okay.
You've got this massive toolbox with everything all jumbled together.
Okay.
Hammer screwdrivers.
Yeah.
Wrenches, and even a whisk thrown in for good measure.
Okay.
It's all useful stuff, but good luck finding what you need when you're in a hurry.
That's right.
That's kind of what it's like for investors looking at Raymond.
It's a bit of a mess for investors trying to figure out what's what.
This conglomerate structure can sometimes hide the true value of each individual business.
Got it.
Let's say you're super bullish on the real estate market in India right now, but you're not so keen on textiles. Investing in Raymond means you're stuck with both.
Okay.
Even if you only want one.
Right.
That's what they call the conglomerate curse. Sometimes the whole is worth less than the sum of its parts.
Makes sense. So by separating everything out,
they're
trying to let each business shine on its own.
Exactly.
Attract the right investors.
Attract the right investors.
Precisely. It's like giving each tool its own dedicated box.
Okay.
So investors can clearly see what they're getting.
Right.
And decide where they want to put their money.
And this
can lead to a higher valuation. For each business. Since investors aren't forced to buy into things they don't want.
Makes sense.
Plus, each business gets dedicated management teams that can really focus on their specific industry.
So more focus, potentially more growth.
Yeah.
And hopefully more value for everyone involved. But let's talk specifics.
Sure.
We know Raymond already spun off its apparel business.
They did. As Raymond Lifestyle listing it separately on the stock exchange, what's next on the chopping block?
Next up is Raymond Realty, their real estate arm.
Okay.
And this one's a real hidden gem.
Okay.
You might think real estate, that's just a small part of their business, right?
That's what I would think.
But it's actually punching way above its weight.
Okay.
In terms of profitability.
Really? Tell me more about that.
So while real estate only accounts for about 17% of Raymond's total revenue, around 1,600 crores in the current fiscal year, it's churning out some impressive profits. Think of it this way. For every euro they make in revenue from real estate, they're keeping about 23 as profit.
Wow.
That's significantly higher than their other businesses.
Wait, so even though it's a smaller part of the overall pie, they're making a bigger slice of profit from each rupee they earn in real estate.
Yes.
That's interesting.
Yeah. It is. And that's why this demerger is generating so much buzz. Suddenly, this under-the-radar business is stepping into the spotlight. They're not just developing a few projects here and there. They've got ambitious plans. They've signed joint development agreements, JDAs, with the potential to bring in a whopping 32,000 crores in revenue.
32,000 crores.
Over the next 8 years.
That's a massive number.
It is.
And where is all this real estate action happening?
They're primarily focused on the Mumbai metropolitan region. Think Mumbai and its surrounding areas.
Got it.
And they've got a smart strategy for growth. They're not buying up land themselves. Instead, they're partnering with landowners, redeveloping their properties and sharing the profits.
So they're tapping into that redevelopment.
They are.
Boom. In one of the hottest real estate markets.
That's right.
In India. And they're doing it without tying up huge amounts of capital in land acquisition.
It's a smart move.
Pretty savvy move.
Exactly. It's an asset-light model, which means less risk for them, and it allows them to move faster on projects.
Got it. But this demerger is about more than just real estate.
It is.
Remember, they also sold their FMCG business.
Right.
Which includes brands like Park Avenue and Kama Sutra to Godrej.
Yes, for a cool 2,800 crores?
Right.
I remember that making headlines.
That sale was a game changer.
It was.
It allowed Raymond to completely wipe out its debt.
It did.
Leaving them with a clean slate
right.
and a ton of cash to invest in the remaining businesses.
Yeah, imagine no more interest payments.
So it's like they've gotten rid of the financial baggage.
Yep.
Sharpen their focus and are ready to race ahead.
That's one way to put it.
But let's be honest, they're not the only players in the real estate game, right?
No, they're not.
How do they stack up against the big boys like DLF?
DLF is the giant in the Indian real estate market, no doubt about it. They've got a massive portfolio of properties, including a lot of commercial real estate, like office buildings and malls, which generates steady rental income. This gives them a higher profit margin compared to Raymond Realty right now. Something like 40% for every euro they earn.
So there's definitely room for Raymond Realty to learn.
There is.
From DLF. And maybe even evolve their model over time.
Absolutely. And that's what makes this demerger so exciting.
Yeah.
We're about to see how Raymond Realty performs on its own. How it tackles the competition and whether it can live up to its potential.
This has been a fascinating look.
It has.
Into Raymond's strategic moves so far. We've seen how they're shedding their conglomerate skin, focusing on high growth areas and setting themselves up for a new chapter.
Absolutely.
But what about the engineering business?
Yeah.
What are their plans after the split?
Right.
We'll delve into that in the next part of our deep dive. So stay tuned. All right, so we've unpacked Raymond's big real estate play, but let's not forget about that other piece of the puzzle.
Right.
Their engineering business.
Yeah.
It might not be as flashy as, skyscrapers.
Right.
And luxury apartments, but it's got its own story to tell.
It does indeed, and it's a story that's closely tied to India's ambition to become a global manufacturing powerhouse.
Okay.
Remember, Raymond owns JK Files, which is a huge name in the tools and equipment industry.
Yeah.
But they've also been making strategic acquisitions to expand their engineering footprint.
You're talking about Maney Precision Products, right?
That's the one.
The one that makes components for everything from cars to airplanes.
That's the one. They're a key player in the aerospace and defense sector.
Right.
Which is a really interesting space right now.
Yeah.
India is pushing hard to reduce its reliance on imports for these critical industries.
I see.
And companies like Maney are right at the heart of that Make in India initiative.
So while the government is trying to boost domestic manufacturing.
Yes.
Raymond is building up its capabilities to actually make those products here in India.
Precisely, and it's not just about meeting India's own needs.
Okay.
Maney is already a global supplier.
Oh, wow.
Operating in 25 countries and working with some of the biggest names in the automotive industry.
Okay.
So they've got the expertise and the reach to really make a mark on the world stage.
Okay, so they've got JK Files, they've acquired Maney, and they're riding the Make in India wave. What exactly is Raymond's grand plan for this engineering business?
Yeah.
Once it's a standalone entity?
They're laser focused on two key areas.
Okay.
Aerospace and defense, as we discussed.
Right.
And automotive components.
Yeah.
And they're not just sticking to traditional car parts.
Okay.
They're also diving into the electric vehicle revolution.
Interesting.
Think batteries, motors, all the high-tech stuff that goes into those next-generation vehicles.
It sounds like they're not just keeping up with the times. They're actually trying to stay ahead of the curve.
That's the key to survival in today's fast-paced world.
Right.
And remember, they've got that war chest of cash from the FMCG sale.
Right.
So they've got the resources to invest in research and development, new technologies, and even more strategic acquisitions.
This all sounds incredibly promising.
It does.
But we also have to be realistic, right?
Of course.
There are always challenges.
There are.
And risks in business.
Always.
No matter how good the strategy.
Right.
What are some of the potential headwinds Raymond might face in this engineering venture?
You're absolutely right. The world is a volatile place.
Yeah.
And no business is immune to external shocks.
That's true.
For example, the ongoing war in Ukraine and the tensions in the Middle East can disrupt global supply chains and make it harder to get the raw materials needed for manufacturing.
So even if Raymond has the factories and the expertise, those global events can still throw a wrench into their plans.
Unfortunately, yes. And then there's the global economic climate.
Right.
Inflation is still a concern in many countries.
Yeah.
And that can push up costs for businesses.
For sure.
And we can't forget about competition.
Right.
The engineering sector is crowded with established players, both domestic and international.
It's a reminder that even with the best strategies and a solid financial foundation, there are factors outside of Raymond's control that could impact their success.
It's true.
So with all that said, do you think this demerger strategy is ultimately the right move?
It's hard to say. Will it all pay off in the end? It's still too early to say for sure. Time will tell whether they can navigate these challenges and capitalize on the opportunities. But what's clear is that Raymond is not sitting still. They're making bold moves, adapting to changing market dynamics and positioning themselves for growth in key sectors.
Their journey is definitely one worth watching.
I agree.
And speaking of transformations, Raymond's not alone in this demerger trend.
That's right.
We're seeing more and more companies choosing to split up, right?
You're spot on. It's becoming a global phenomenon.
Wow.
And it's reshaping the corporate landscape.
Interesting.
Companies are realizing that sometimes less is more.
Okay.
By focusing on their core strengths, they can unlock value, attract targeted investments, and become more agile in responding to market shifts.
It's a fascinating trend.
It is.
And I bet our listeners are wondering if we'll see even more big names jumping on the demerger bandwagon in the coming years.
I wouldn't be surprised at all. It's definitely something to keep an eye on. And you know what's really interesting about all of this?
What's that?
It's not just about, maximizing profits for shareholders. It's also about recognizing that the Indian economy is changing rapidly and businesses need to adapt to survive.
You're right. Think about it. The rise of e-commerce has completely shaken up the retail landscape.
It has.
Traditional brick-and-mortar stores are struggling.
They are.
And even big brands like Raymond need to rethink their approach. By separating their lifestyle business, they've given it the freedom to innovate and compete in this new world of online shopping and fast fashion.
Exactly. As if they've untied the anchor that was holding them back. And on the flip side, you've got these other sectors like real estate and engineering, which are booming in India. The government is pouring money into infrastructure projects. Urbanization is driving demand for housing. And there's a renewed focus on making India a manufacturing hub. By creating these focused entities in these high-growth areas, Raymond is essentially placing strategic bets on the future of the Indian economy.
So it's a bit of a balancing act.
It is.
Shedding the old skin while embracing the new opportunities. It's like they're saying, look, we've been around for almost a century. But we're not afraid to shake things up and reinvent ourselves to stay relevant.
That's a great way to put it. And I think it's a valuable lesson for any business, big or small. The world is constantly changing. And those who can adapt and evolve will be the ones who thrive.
So for our listeners who are trying to make sense of the business world, what's the key takeaway from Raymond's story?
I'd say there are a couple of big takeaways. First, corporate restructuring, particularly demergers, can be a powerful tool for companies looking to unlock hidden value, sharpen their focus, and attract investors who are aligned with their vision. It's not always easy, but it can be incredibly effective.
And the second takeaway?
Always be on the lookout for companies that are willing to embrace change and adapt to new realities. Those are the companies that are likely to be the most successful in the long run.
Great advice. So the next time you hear about a company splitting up, don't just skim the headlines. Dig a little deeper. Try to understand the rationale behind the move and see if you can spot those signals of change and adaptation. It might just give you a glimpse into the future of that company.
It might.
Or even that entire industry.
Couldn't agree more.
Well, this has been an incredible deep dive into Raymond's demerger story.
It has been.
We've covered a lot of ground. From textiles to real estate to engineering. From conglomerate curses to asset-light models to the future of the Indian economy.
We did.
We hope you found it insightful and engaging.
I hope so.
It's been a pleasure joining you today.
It's been a pleasure being here.
Always a great conversation.
Always is.
And for our listeners, if you enjoyed this episode, please don't forget to like, subscribe, and share it with anyone who might be interested in the fascinating world of business and finance. We'll be back soon with another deep dive into a trending topic. So stay tuned and stay curious.